What? Well, welcome back to another episode of Watch a True God Moron Trade Options. This is a ridiculously perfect example of what not to do. What not to do. Also, do as I say, not as I do. Oh my God, please do not copy what I'm doing. Oh, Lord have mercy. We got our asses kicked today. And this week in general, really. As you can see, we lost a very large portion of our portfolio today. 22%. Just today. How, you may ask? Or may wonder? Disney, that's how. In classic moron fashion, I went long Disney at what I thought was the bottom. And to be honest with you guys, I actually did call the bottom. I called the bottom right there. Actually, it was more like right here. But I called a bottom about 44.50 or so. Called a bottom, went long with a $146 call on Disney. And we were looking good there for a little while. But I should have taken profits earlier today. I should have taken profits right there. And like I told you guys, like we talked about in the last video, you have to take profits, otherwise we lose our edge. You have to actively manage these accounts. And I was quite literally and figuratively sleeping on Disney, because if I took profits right there, we'd have been up $100 for the day. That was where Disney topped out for the week, and that's where we should have taken profits. If I had set a profit target to begin with, we'd be in the green for the day and the week. We'd still be down overall, but we wouldn't be getting murdered. So this is our weekly outlook, down 42% in a week. What a moron. But yeah, we could have actually been up for the week a whopping $4 and not down 42%. Good grief. But look, this goes to show you guys, y'all have to do as I say, not as I do. Do not. Well, the first mistake was risking way too much of our portfolio on one bet, right? The first option I bought was like $60. And that is way too much to risk on a $500 portfolio. Mistake number 2, piling on to a losing position. I cannot stress this enough. Do not do that. If you're buying equities, averaging down is not a bad strategy. Because if you buy, let's say you buy a stock at $10 and it's heading down, and then you buy another share at $9, well, your average share cost is $9.50. So that's averaging down. If it keeps going down, you buy a little bit, buy a little bit, buy a little bit. If you are long-term bullish on that equity. Options, it's almost never a good idea to pile into a losing position. So the options kept losing, so I averaged down and wound up getting into about $150 worth of poo-poo, basically, is what it amounted to. Poo-poo. Oh, Lord have mercy. I think there's some sort of rule about me being able to go back and show you the historic trades. I think that's one of those, I'm not a certified financial advisor, obviously. This is just for entertainment, blah, blah, blah. I don't think I can go back and show you, but I'm telling you, that's what happened. I wound up with 3 long calls on Disney, totaling about $150, and got wrecked. Now, why aren't we down $150 today? Because we actually hit a couple of our sells. And I started this channel to do selling. We were going to be net sellers, right? So all of the credit spreads that I sold this week actually expired worthless. We did good there. I sold 2 iron condors, and both of those expired worthless. So we actually won the majority of our plays this week, but we just lost the one big one, and that is a tragedy. It's a travesty, and I'm a moron. So I think the big one was Walgreens again. And if you're wondering why I keep going back to Walgreens, it's because it's liquid. And that means that people are on the other end wanting to buy the options that you're selling. It trades relatively sideways, so you can kind of make a market bet, that's not too far out of the money, get good premium, and have a high percentage chance of hitting it. And here's another thing that I want to get across to you guys is you don't need to find like the biggest winners and the biggest movers all the time. You just build a watch list that you're comfortable with, right? So this is like a stock watch list. But let's go down to Walgreens here. And we've been watching Walgreens for like 4 weeks now, right? So we know what Walgreens about where it should be trading, because you can see this month it's been a high of 59ish, almost 60, and a low of 57 over the past month. So we know the ranges where Walgreens is going to be trading, especially in this last month that we've been doing this channel. So we can make a more educated guess or bet on Walgreens as to where price action is likely to be, right? There's a lot of liquidity. People are on the other end wanting to buy the options that you're selling. And that's a big deal, because when you go to get out of a position, let's say you're in your profit target and you want to get out, there has to be somebody on the other end of that to buy or sell the option that you're wanting to buy or sell. So that's a big deal. And also, is not for nothing, but this is sort of one of the factors that led into me piling into Disney. Was I was getting, this is probably mistake number 3 or 4 or 10, is getting frustrated. So I was getting frustrated with a lot of our credit spreads weren't being bought. So we weren't getting a lot of action, and we weren't getting any content to show you guys how all this works. So a lot of my cells were going unfilled. So I was just looking for some action, like a junkie, like an idiot. But yeah, so we need to find more liquid stocks, even if the ones we are looking at aren't getting filled. Move on to the next one. Is exactly what I should have done. We tried to sell some RSX, some UVXY, some United States Steel. What else did we? Capri. Yeah, we had like 6 credit spreads and iron condors that we put in earlier this week that didn't get filled, and it's just it starts to get frustrating. But listen, you just got to take what the market gives you and take the profits that you get, manage your losses. I probably could have exited Disney earlier and minimized or mitigated those losses. But yeah, man, I'll tell you, do as I say, not as I do. Be a net seller. Don't pile into losing positions. Don't take on so much risk. If you have a larger portfolio than this, you can take on a little bit more risk, right? If it's 5%, you can handle that. If it just goes bust, you can handle that. But $150 worth of risk in a $500, which was actually more like a $400 portfolio when I made those buys, is idiotic. It's a great way to lose money. If you want to blow up your account, take on 30 and 40% risk. And when I say blow it up, it can blow up or it can blow up. You know what I'm saying? Up or down. But yeah, so that is the end of week 4 or 5. I don't even know what week we're in. We're in just ass whipping territory. Obviously, we started at 500. Oh, Lord have mercy. And we're down to 228. We are down 54%. And that is not good. That's not good. We gotta make some moves here. The only thing we have hot right now, the only thing we got working is a cons call. If you were to look at the technicals on cons, it looked like a bottom. So I decided to pile in for no reason other than what the charts said. This was probably the reason why it was like ridiculously oversold. This huge cliff right here. I am not suggesting that you pile into cons. I'm just saying the technicals are ridiculously oversold. And not for nothing, but most analysts are saying buy it. Anyway, let's not get into that. Keep selling. Don't pile into losing positions. Don't do anything I do. Just do the things I say, and maybe don't even do those. I don't know. Anyway, I got to find a way to dig myself out of this hole. Anybody got a shovel I can buy? Probably can't afford it. Until next time, we'll come back with some plays on Monday. Try to dig ourselves out of this hole. But until then, the loser, T-Fade, signing out. Peace.